Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. Anthony, how are you today?
Man, I am doing well today. I'm excited. We had started this series of Becoming Your Own Banker, and really that's based on Nelson's book for teaching people how to use the infinite banking concept. And we got sidetracked on real estate and taxes, and so now we are back. And I'm really looking forward to this section. In part, the other 5 sections, I think were very good, but we're now at the point like where the wax on, wax off, right? You know, I do love Karate Kid and Cobra Kai, right? I'm another plug out there. If you want to watch, if you love Karate Kid, they redid a YouTube TV show called Cobra Kai. Same actors, same plot. But now instead of them being 16, they're now in their mid 40s. But this reminds me of the scene where Daniel's like, you know, I'm sick and tired of painting your fence and waxing your car. I want to know karate. And then right then is when Mr. Miyagi starts throwing punches at him, and he's painting the fence and blocking him and waxing on and off and blocking him. And just like if you want to win the All Valley tournament, right? you just can't start doing karate. You need to understand the basics. You need to have a good foundation. And the same thing goes for the infinite banking concept. A lot of clients I run into, and even me, when I first heard about it, I wanted to get in, and I want to get in the numbers, and I wanted to start doing this. But as Nelson had said time and time again, the infinite banking concept is really a way of thinking. And we need to have that foundation. Like the painting the fence, that is like the five human laws that we had talked about. We need to know the basics. If we want to win the All Valley tournament, or if we want to create that passive income and that lifestyle we want, we need to take some time to learn the basics. So we've done that. So now it's time to training for the All Valley tournament.
Great analogy. Great analogy. I love Karate Kid, but absolutely, this is in Nelson's book. This is where you go from kind of the conceptual piece to the application piece. And I've shared this story before, but I remember when I was reading this book, and this is the page that really kind of set me off. In 2 ways. One, I was angry. I was kind of pissed off because nobody told me about this before. And then also number 2, it set me off down this trajectory of just reading and researching on this strategy. So I'm excited to get started. I've used this and referenced these few pages in Nelson's book I don't know how many number of times. So let's get going. What do you think?
I agree. And, this was a turning point for me when I was reading the book as well. If you look at it, we're on page 44, and the book is less than 100 pages. Really, I mean, so the first half is really about mindset and how this works. And when we finally got in the numbers where I could kind of see this put into play, and I was with you, I was pissed off. Like, why didn't my financial advisor tell me about this? Why hadn't I heard this before? And literally, after I read this part, I really couldn't sleep the next few nights. I kept on thinking, does this really work? How would this work for me? I have a big family. We buy more than one car every 4 years. So how would it work for there? And that's when my mind really got exploded, where I really got excited to learn about the infinite banking concept.
Absolutely. I agree. Well, let's jump right in here. Page 41, right? This is where Nelson kind of introduces us to the 5 strategies, the 5 methods of financing just a vehicle, a car, right? One thing I will say as we kind of jump into this is I want to preface this to our listeners is that we're going to be talking about cars here, but if you're listening to this podcast at all, we typically don't focus on kind of depreciating assets, right? So I know my focus has changed over the years. Is I started out kind of talking about cars and financing those things, but over the last several years, we've really talked about real estate, or we talk about using our cash value to purchase appreciating assets that are going to provide cash flow to us. So I want to throw that out there. Anything you want to add to that?
No, well said. Nelson wanted this to be as simple as possible, and everybody can relate to buying cars. Just as you said, this example is cars, but this really goes to anything that any major purchase, whether it's a rental property, or maybe you're expanding your business, or buying any sort of investment. All of these relate to you could just change the noun or whatever the asset is that we're buying to whatever relates to you.
Awesome. And again, just to kind of second that, is that Nelson wanted this to relate to everybody. He talks about the all-American person, right? Handing this. And I think the income that he talks about is somebody having $35,000, $40,000 of income and saving X number of dollars. And so that's what this example is based around. So let's jump in there. 5 methods of financing a vehicle is what we're going to do is I'm going to name them off, and then we'll kind of backtrack and we'll kind of go through the pros and cons. Is 5 methods of financing. First one we're going to look at is going to be the leasing method. Second method is going to be the bank financing. Third one is going to be paying cash, and this is the one that I was fully aware of and was practicing at the time. Fourth method is going to be the CD method, and then the fifth one is going to be called IBC, which is the infinite banking concept. So Anthony, if you want to start us off, tell us a little bit about the leasing method for our listeners. Just touch on it briefly.
And leasing is we're just really renting.
Yeah.
We are not building any equity. A lot of times it can be attractive at the beginning because you see this low monthly payment. However, you are just renting the vehicle. All those payments are a complete expense. So Nelson didn't spend much time on this, and I think neither will we, because this is pretty evident that all those dollars are continuing to flow away from you.
Agreed. And then bank financing is similar, right? This is when you go and you approach a bank and you say, hey, I want to borrow $20,000 to go buy this vehicle. And they say, great, we'll give it to you. Make sure you got a job and a track record of paying people back. So they'll do a credit check, and then they'll charge you an interest rate, right? So what you're kind of out of there is at the end of it, you do have the car. So you've got some equity that's left if you want to sell that. But what you're out the interest that you paid them for using their money.
And what I think an important thing to make is when we borrow money and we're paying interest, what we're really doing is we're using somebody else's savings. Somebody else had to save that money and allow it to be loaned. So the biggest downside of bank financing is that we are losing interest.
Right. So that accumulation or that capitalization phase, which brings us right into option 3, which is cash. Right. So now cash, we've saved up money and we can now go and we can pay cash for the vehicle. Right. Everybody understands that. And the pros with that one is at the end of it, we do have equity in the car, and we also saved ourselves from paying interest to the bank.
Yeah. One key thing that, in order to pay cash, you need to first save up money for that first purchase. So you do need to, you're not going to have a car right away. Right?
Yeah. No, you got to wait. You got to walk.
And then Cameron, what's the downside of paying cash?
Downside of paying cash is your opportunity cost. Is what that means is that if you save up cash in a checking account or something that's earning interest, is the minute that you take that money out to go purchase the vehicle, is that those dollars stop earning for you. And people kind of disregard that idea of, hey, not a big deal, but you got to remember when you take cash out, it stops earning for you this year and next year and the following year, right? That is into perpetuity. And so when you spend cash, is you are interrupting that compound interest curve that we've talked about before.
Great. I mean, there's really 2 reasons, right? Which you had said both. I just wanted to clarify that opportunity cost. If you buy that car, that means you lost the opportunity to maybe buy an asset.
Yeah.
And what I think is the most important piece is you mentioned compound interest. Whenever I ask somebody, I always ask them, when do you want to stop earning compound interest?
Never.
Right? Everybody says never, but when you're paying cash, you save up money, and then you buy that asset or that car, you drain your account to zero, and you've broken the compound interest curve, and you have to start over. And then you're like, okay, well, now I need to save for another car. So here's one interesting thing about paying cash. A lot of the times people think they don't have a car payment, but if they want to buy car number 2 in cash, they need to save up for it. So maybe they don't have a legal requirement of a car payment, but they're obligated themselves to start saving money for the next car.
Absolutely. What happens, people pay cash for a car, and then they don't have systematic payments to a lender, but they're just making quote unquote payments or deposits back in their checking account to rebuild that saving position. Awesome. Let's jump into option number 4, right? This is the CD scenario. So, Anthony, can you tell our listeners, since you're the accountant, what is a CD? What does that mean?
CD for the listeners or for you? A CD is a certificate of deposit where you give your money to a bank for a specific period of time. Maybe it could be as short as 3 months or 5 years. You give them the money for that period of time, and in return, they will give you a higher interest rate than you normally would in the savings account. And if you do have an early withdrawal, there is going to be a penalty.
Perfect. Is there anything else we want to touch on there for the CD?
Well, in essence, what he's doing on this CD, I think what Nelson's trying to do is, some people are going to say, well, you know what? I don't need or want life insurance. Why not? I mean, I can just do this myself. And I think that's what the CD option is, where what he's doing is he's building up enough money. In this example, he's putting $5,000 a year into a CD. So they are delaying buying the car. And then after year 7, he takes a withdrawal of $10,000. He takes a withdrawal of the CD to buy the car. And then he wants to be an honest banker. So what in this example he did is, the guy went to the dealership and says, well, hey, if I was going to buy a car, what were the terms of the loan going to be? And he's like, you know what? If I was going to pay the bank, sorry, Cameron, I talk with my hands, I'm Italian, but if I was going to take this money from a bank, I was going to pay them interest. So I should at least pay myself that same amount of interest. So that's what, in this example, the CD person does, is instead of making a car payment, they put their money back into buying another CD. And then every 4 years, they take out the money to buy the car. And each year or each month, he's making the quote unquote car payment back to himself. And they do this for 11 cars.
That was great.
Okay.
You jumped ahead a little bit,
Sorry.
so I'm going to back up, right?
Okay.
So what we were talking about is we're talking about the 5 methods. We went for the first 3. The first one was leasing, banking, bank financing, paying cash. And then what Anthony just gave us was the CD option, which is where we go to the bank, we use the CD. And then he kind of went through some of the transactions that we're also going to look at too. We also need to bring in kind of that 5th method first before we kind of make that comparison. Because what Nelson does on page 41 is he said, hey, here's the 5 ways that we can do it. CD being the 4th, IBC being that 5th option. And IBC, infinite banking concept, is really just using that life insurance policy and the cash value as your storehouse for wealth, right? That's where we're going to keep the cash. And so instead of keeping your money in a checking account or savings account, which is kind of that cash option, the next step up, what Nelson tells us is, let's look at a CD, right? We're going to hit a higher earnings rate, but we still have somewhat access to it. And then the very last option we're going to look at is going to be that IBC option, which is using the cash value. So now let's kind of jump into kind of that comparison of, hey, listen, what Nelson says again on before I go forward is, out of those 5 scenarios, only 2 of them are profitable. Right? And so what really struck me back in the day when I read this was that I wasn't even aware of the 2 options.
Right.
Right? Because nobody even told me that there was a better option than paying cash. Is when I was growing up, right, it was always told for me from parents, friends, from everybody else around me that paying cash was the best option. And that was part of why I was so angry, because I'm reading this book and here's 2 options I'd never even heard of. and yet they're both profitable. Right? And I'm like, why the heck did somebody not tell me this? And so that's what Nelson's doing on page 41 through 48-ish. And the example that we're going to look at is on page 45. But he says, listen, only 2 of these are profitable, so forget about the rest. Let's take these 2 and let's compare them. Let's lay them out side by side and see which one wins. And so that's what we're doing. And so what Anthony just gave us was kind of the transaction part of it. So hope we got everybody caught up. Real quick, if you could go back through that transaction process just briefly, so now everyone understands what we're doing. We're putting money into, what we're going to do is we're going to compare the CD and the IBC option. We're putting money into each system, right? $5,000 each, right? And then we're going to do that for 7 years. And what do we do in year 8, Anthony?
In year 8, we buy our first car.
So along with the car comes what? Car payment, right? And so now once we use each of these methods, is whether we're withdrawing money out of the CD or we're taking a loan against the cash value or surrendering it, is we've got to pay that money back. And so in both scenarios, we have $250 a month going back to each of those systems to replenish those accounts, right?
Right. And let's cover, because a lot, well, first, we are going into detail on page 45, and I bet most of our listeners are probably driving in their car. True. And it's hard to convey numbers through a podcast. So what Cameron and I have done is we've created an in-depth video where we go in to page 45 into detail. And if you haven't bought Nelson's book, Becoming Your Own Banker, we highly encourage you to do so. In the show notes will be a link to the video of our comparing the CD versus IBC. We also did another video that compares paying cash versus IBC. So we're going to go ahead and include that in there as well. We will also include a link for you to buy Nelson's book. Great.
So when we're looking at these two, is again, let's not get too far into the numbers, but let's compare these two options, right? So we're going to do the same transactions. We're capitalizing for the same amount of time frame, the same amount of money. And then what we're going to do is we're going to borrow or we're going to withdraw and go purchase the cars and pay each respective system back. Big picture wise, Anthony, how do these two compare when we fast forward 45 years or whatever we're fast forwarding to?
Well, in Nelson's example, 45 years later, well, if we go to 51 years later.
I'm going to jump in here. Sorry. I might have jumped ahead here. Is when we compare these two methods, which one looks better early?
Okay, good. I'm glad you opened that up. If we look at year 1, in this example, IBC program, one thing we've commonly used is to compare these is say that they're twin sisters.
Yeah.
So you may hear us say IBC sister or CD sister, right? So now in the first year, in this example, the CD sister bought a CD for $5,000, earned some interest. And so they have about $5,200 at the end of year 1. Now, Cameron, how much does the IBC sister have?
So the IBC sister, again, just to remind our listeners, is the IBC sister is also going to have $5,000, start the year off with the same amount of money, but she's going to go send $5,000 into a premium for a life insurance policy. And so some of that has got to go to the death benefit, and then some of that's going to go to cash value. So in year number 1, she's got just over $1,900 of cash value that's available for her.
Okay, so at Christmas dinner, who thinks that they are killing it?
Oh, CD sister is laughing right at IBC sister.
I told you about that life insurance and all that stuff. But one thing we need to take into account, just like Nelson says, we are creating our own banking system. Right now, CD sister is using somebody else's bank. Mm-hmm. So those owners already established the bank, already had the startup costs of starting any business. And now with IBC sister, she is just starting out. And I will say, I think that this is one of the biggest obstacles people get when they look at IBC. They are focused on those short-term results. Well, year one, I don't have all of my cash value. Why would I even do that? Look, if you're focused on the first couple of years, IBC is not for you.
No.
You really need this is a long-term strategy. And as you're going to see, this is going to pay some major rewards for somebody who follows this program. But there's going to, those first couple of years, there is going to be a slow start, right? But the CD and the IBC sister will catch up. And when the IBC sister catches up, she's never going to look back.
No. I'm looking at some of my notes here. This is one of the original books that I had back in the day, and I'm looking at it, and I've got little pluses and minuses by each side. So I went through and I wrote pluses, minuses, who was ahead each year. And if you compare it, we're comparing 64 years is what we're comparing. The CD sister has 14 pluses by her name, which means that she was ahead for 14 years. On the other side, the IBC sister has 50 pluses by her name, right? So when you look at what happens is the CD sister is ahead until you're 14, 15, and then it flips. IBC sister has caught her, and now she's going to pass her. And this program just has this increasing efficiency, and she just continues to pull away from the CD sister in this example. And so when you look at it and you compare it, you've got 50 pluses on this side, or you've got 14, and all those 14 pluses are on the front end of this, comparing these systems. And so, right, when we're talking to clients, and even for myself, is I got to remind myself not to be short-sighted.
Right. And we like to compare this to being a race where this is not a sprint. This is more of a marathon. And, if train this program, here's a question. What's more important to you, being in first place at the beginning of the race, or being in first place at the end of the race?
At the end. I want to cross that finish line first.
Exactly. And what Nelson showed here in this example, the IBC sister caught up with the CD sister in year 15, right? But here's the thing is, in this example, you're going to buy cars, right? Are you going to stop buying cars in 15 years?
No.
Right? And the only way that this individual is not going to buy cars would probably be as if they died. Okay.
True. Thanks.
So, right now, if the IBC sister dies early, who's ahead then?
Oh, IBC sister, with the insurance policy.
Yeah, I know we do focus on the cash value, and that's typically why most of our clients are using IBC, but we don't want to discount the value of having some death benefit.
Agreed. And to just use your analogy of a marathon is, right, if I was going to train you for a marathon, I got it here in my notes, is if I told you you'd be trailing the first 14 miles, but you'd blow the competition away at the end, would you let me train you?
Cameron, I would have to get my ego aside to have you train me, and I don't know if I could do that, but I think I can. Right?
Yep. And when you fast forward these numbers and you start looking at the numbers at the bottom of this page, is, again, to use that race analogy, it is not a photo finish, which means it's not even close, right? There is a clear winner at the end of this. And so let's look at these numbers. Let's fast forward. What do we want to look at numbers, or we want to just keep it conceptually?
Yeah.
Perfect. So let's keep it conceptually, and we'll save the numbers for the video. But if you want to discuss a factor of differences between the two, whether the CD system and the IBC sister, who wins and by how much?
Really? So we're going now down to 51?
Unless you want to add something there?
No.
Okay.
No. In essence, what they do is they each continue to buy a car and pay it back, right? And then in this example, when they're 51, the IBC sister has 4 times as much as the CD sister. So here's the question. They put in the same amount of money, right? They bought this, they took out the same amount of money, same in, same out. Why does the IBC sister have so much more?
I don't know, Anthony. Tell us.
A lot of it is the characters in the play. Like Nelson had talked about in regards for a bank to work, you're going to have some admin costs. You are going to have dividends going to the owners. There's going to be interest paid to CD holders, and all of that. The only thing that makes that work is a borrower. The borrower is the one who is paying the costs for the admin, paying interest on that the bank's paying on the CD, and they're paying the dividends or the profits to the owners. All of this process is exactly the same. The only difference is there's one change in the character of the play, and that is who is the owner. In the CD sister, the owners are Wall Street. And now, Cameron, who are the owners with the IBC sister?
The IBC sister is the way that I would say it is you're partnering with a mutual insurance company. And the reason I say that is because as an owner of a policy with a mutual company, at the end of the year, the dividend or the profits are redistributed back out to the policyholders. So you are participating in the performance of that company.
Exactly. So would it be fair to say that the difference between the cash value of the IBC and the CD sister is the profits that the bank made off of your purchases?
Absolutely.
How does that make you feel?
Angry.
Yeah. I thought banks were our friends, right?
Yeah, sure.
No, but you know what? Just taking control and being able to look not short term, but long term, you're going to get the profits that normally Wall Street or the bank would be getting. And this was a very simple example. This guy is buying a car every 4 years, and a lot of times, families buy more than they have a couple cars.
Yep.
I mean, so what if you did this, bought a car for you and your wife or your kids? Or what if you bought finance other cars for members of your family? Or really where I think where it gets exciting, just as Cameron said, Nelson just made this very simple with somebody buying a car, which is a depreciating asset. What if we use this to buy cash flowing assets?
Mm-hmm. I love it. And one thing I'll say, you said that Nelson wanted to make this very simple, but man, the more times you read this book, the more times you understand how subtle Nelson was when he wrote this. Is because one of the things I just wrote down as we're talking is this page right here establishes ownership. He is showing us how important ownership and being an owner in something is. And then in the latter pages is he's going to show us what happens when we take control, right, of the financing function of it. So to me, page 45 is really about ownership and saying, hey, listen, you can outsource the financing that's going to take place in your life over the next however many years and your kids' years and all that stuff, or you can bring that in-house, take control of it, and own that piece of it. And so I love this piece for it. I love these pages, and I've talked about it numerous times.
Yeah, no, and this is what got me so excited. I mean, this is something that you're going to do anyways, right? But now, not only do we have more cash at the end of the day, but now we have the ability to create tax-free cash flow in retirement.
Yep.
And the way Nelson designed this example, there were no policy loans. He actually took a withdrawal of the dividends to buy the car. And when I've talked to him, he said he would never do that himself. All he wanted to do was be able to carve out the actual banking piece. That he said the problem with the way he did it, even though it was easier to understand, we broke the compound interest curve. That ideally, in this example, we only capitalized a policy for 7 years, and then they stopped. That ideally we should continue to capitalize, and when we take money out, take it as a loan and pay ourselves back. That way we never break the compound interest curve, and then we're going to have even more cash flow when it comes time to retirement.
I agree, and we'll share those 2 points that we just talked about in the videos that we do, is because there's some things that are done in here, right, that can be improved, right, as far as surrendering versus taking loans. And so we've got a really good base foundation example here in the book. We're going to recreate that, but we're also going to do it and show what it looks like with kind of some updated numbers as well.
Yeah, and I'm glad we're back into the series of becoming your own banker, because actually my favorite page, do you know what it is? I have 2 favorite pages.
Page 70.
My favorite.
Page 70 is a spreadsheet, so
it's actually page 69, when he talks about, well, I can get a higher rate of return. He does I don't know how many times I have heard that, but when Nelson's talking about, this isn't an either or. This isn't do this investment or IBC. That IBC is an and in there he shows the power of actually doing your investing through a policy. But what I also, so 69 is my favorite, and my second favorite, since you asked, Cameron, is going to be page 59, 69 to 59.
Okay.
So I think we're the 59 is the equipment financing. I think we may be doing that maybe in our next IBC podcast, but that one is going to be fun, and I think that it sheds some more light on the power of IBC. And I will say is, if you're listening to this podcast, you may think, well, how do I get one of these policies? Or maybe you already have one and you're not sure how to use it or if it'll work. In the show notes, there is a link where you can get on a 15-minute phone call to Cameron and I, and let's have a quick little chat and kind of see if IBC is for you. We can point you into some other resources. We could review a policy that you have, and or we can show you how to get an IBC design policy.
Awesome. Look forward to it. We'll get those videos up and in there for you guys. Thanks for listening.
Make it a fantastic day.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.